Bismillahirrahmanirrahim. Assalamu alaikum dear students and viewers. Welcome to my YouTube channel DigiLearnersPoint. This video will provide you the solution of assignment number 1 of International Management, which has subject code MGT201. So without wasting time, let's start reading the questions, and then we will move to the requirement, and finally we will discuss the solution. Topic is related to the valuation of securities. Securities may be bond or stock, so maybe preferred stock, something else. Risk and return of an investment go side by side and largely depends upon the risk appetite of an investor. Risk takers investor bear an extra risk for more return, while a risk averse investor forgoes high return by choosing a low risk investment option. Investors have different options to invest, ranging from zero risk securities to highly volatile securities. Among these different available options, stocks and bonds are the two commonly used securities preferred by the investors. Ahmed and Arslan are planning to invest their savings in stock market. Ahmed is a risk averse investor and wants a secure investment with fixed return, and Arslan is a risk taker investor. So they are highlighting the two persons, Ahmed and Arslan, and then both are categorized as per the nature of the risk. Arslan is a risk lover and the Ahmed is risk avoider. So in that scenario, you are going to be calculate the options you have been given, and you have to be decide which option is related to the Ahmed or Arslan. So let's start to the options. First option is related to the bond. 10-year bond with face value of ₹1,000 paying a semi-annual coupon. The bond was issued at premium and currently selling at ₹900 in the stock market, whereas annual coupon rate is 15%. Second option is shares of a company with face value of ₹85 per share. The company has paid an annual dividend of ₹12 per share last year, which grows at 5%. The shares are currently selling at ₹73 per share in the market. In the stock market. So this is information regarding the share of a company. So required, recommend suitable investment option from the above two based on the risk appetite of Ahmed and Arslan. Your selection should be based on some reasoning. Calculate intrinsic value of both investment options. If required rate of return for both options is 18%, and identify whether the securities are undervalued or overvalued. So let's move to the solution. Part A, we will pick up the Ahmed because he is a risk avoider averser. He interested to be in fixed income on regular basis with the security point of view. So investment in bond is good option for the Ahmed because he will receive ₹75 for every 6 months for 10 years, and at the time of maturity he also gets back its principal amount of ₹100 while he invested only ₹900. In case of default, company will pay first to bondholders and then please correct this, then shareholders. Element of volatility is less involved or associated with bondholders or bond price. Bond market. Arslan, he is a risk lover or risk taker, highly volatile investment option. As fluctuation is high, return is also high. Company giving dividend that associated with potential growth of 5%, can earn capital gain as a result of price appreciation of the stock price. Now come to the part 2. We need to find out. Let's move back to the option required number 2 to read out again, and then we will find the calculate the intrinsic value of both investment option. Okay, move to the solution. So we need to be find the intrinsic value of both bond and stock price. So on the basis of that we are determine it is undervalued or overvalued. Bond maturity is 10 years, coupon rate is 15%, which is paid semi-annually 7.5%, face value is rupees 100, or fair value you can say that payment semi-annually, which is 75 divided 150 divided by 2, or multiply 7.5% by 100. Frequency 2 times in a year, number of periods multiply 2 by 10 is equal to 20 periods. So, and current price of the bond is rupees 900. So required rate of return for both bond and stock is 18%. Half yearly is 9%, because it is for bond it is applicable. Half yearly because it is make payment on semi-annually 9%. So we use this formula to find the intrinsic value, which is NPV value, also called or fair value. PV is equal to CF cash flow every 6 months divided by R. It may be R divided by 2 also, but it's a general formula on the basis of annual basis. 1 minus 1 plus R raised to power minus n, plus fair value divided by 1 plus R raised to power n. So I have separated this formula into two components, this one and this one. Present value of CFE, all cash flows 68.4, and the present value of principal 178. It is obtained by how I am going to obtain this one? Divided 1000 by the 1 plus 0.09 or 1.09 raised to power 20. So same this formula, look at this. I am going to use this formula here. So by adding both these elements, we will get the intrinsic value of bond, which is also known as NP of the net present value of the bond. No, it is not net. Your book said that net present value of the bond. Please recheck it from your book. So now come to the conclusion. As IV is less than MP, it is undervalued. Now come to the stock. Face value is rupees 85. Dividend is equal to rupees 12 previous years. Growth 5% previous years, as based on the previous years given in the statement. Share price currently in the market rupees 73. Required rate of return is 18%. Intrinsic value is equal to D plus P naught divided by 5 plus R. Intrinsic value is equal to 72.033, and it is also less than 73. So it is undervalued. So I hope you will find this session useful. If you found any error or mistake regarding calculation or value or figure, please comments in the comment sections, or if you want, or if you want to add something from your side, drop your suggestion in the comment sections, or if you want to discuss any point regarding any step, you can discuss with me in the comment section. Thanks for watching. Assalamu alaikum.